Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk, how are you today?
Doing great. Doing great. Just got back from vacation down in Florida. It was a lot of fun. Definitely needed it. Although I need another vacation just to make up for my other vacation because I got thrown into the weeds yesterday, and God, it makes you hate vacations because afterwards you got to do twice as much work to catch up. And um, yeah, it's funny. Every year we try to improve our vacations, and last year we did it well. We're just like, yeah, we got to take off like I forget like 1 or 2 or 3 days after vacation just to like ease back in. And we didn't do it this time. It was a horror show. But anyway, at least the kids got a day off to rest because our
That's right.
plane flight got back at like I think we went to bed at like 2 in the morning. It was crazy. Anyway, but you guys don't need to hear my woes. You're here to listen to to finance. So we'll get started here. So yeah, there's a few things I want to talk about, and it's been an interesting week. But I wanted to start off with, let's see, one of the listeners sent in some comments, and I wanted to mention one of them because I thought it was really interesting. We have this segment we call Chart Crime, and I want to do more of it. Unfortunately, I don't have so many hours of the day to do it, but the whole segment of Chart Crimes is to really talk about the narrative that a chart is delivering. That's the whole point, right? It's not that they're right or wrong because I have no idea, right? A chart is delivering a story. It's a picture, right? And pictures are another way to deliver a story, right? Cartoons are picture stories, right? And there's a whole theme of people who have what do they call it? Illustrative stories, or there's another word for it. It's not comics, but they're like they're really longer books. They're really illustrated books, but they're in the form of a comic book. And anyway, the point is the charts that we show and other people show are to deliver a narrative. So the reason we point them out is so if you're looking at a chart for like the last 5 years, it's like, oh well, in recent history, this is the most like it's ever risen. Well, yeah, but if you look back in 50 years, it's not even close. It's like a blip. And this is what people were doing with the rate hikes. They're like, oh, this is the fastest they've raised rates in modern history. It's like, well, where do you stop that? Because in the 70s and the 80s, they went a lot more than that. But it always stops like right before that, right? So it never shows this other piece that would totally destroy their narrative. And the news and everyone, nobody ever bothered. They just kept, piping out the same chart everybody else put out. And we pointed that out. The point is a chart crime because we pointed out the fact that they clearly missed the biggest rate hike in modern history, depending where you stop that, in recent history, was actually in the late 70s and early 80s. That went much faster, but they don't point that out because all of a sudden it's not interesting. It's no longer news. And that's a big part of it. Also because they're trying to deliver narrative. And anyway, it's a different piece. Now, what the listener pointed out, listener Charlie, so thank you, Charlie, for pointing this out. We're going to use this as a lesson today. I will frequently point out, talking about, you pointed out the NASDAQ, I'll just point out all indexes. If you point out that very frequently people will say, well, equities are the best performing asset class. I'll say, well, yes and no. Actually, not for the last 40 years. In the last 40 years, 30-year zero coupon bonds clearly outperform equities by a lot. Now, that is in part because we were in an epic bond bull market. Interest rates went from 20% down to zero. So bonds made a lot of money if you bought a 30-year zero coupon bond in I think it was 81 was the peak. If you bought it then and you held it for 30 years, it was the best performing asset by a long shot. Now, if you were invested in equities, it was a very great performing asset class. Was it better than the zero coupon bonds? No. That's one thing to point out. Now, the reason I bring that up first before we talk about this period that I typically talk about, which is 2000 to 2013, the reason is that the markets go through cycles. Now, for the last 100 years, what's been the best performing asset class? Well, I believe it's equities, right? Clearly, because you're looking at a very long period of time. You're including different cycles, and if you just look at a shorter period, like a 5 or 10 year period, anything can apply. It's random chance, right? If you look at 100 years, it's hard to argue random chance is in there because you've got the more data points you have, the more accurate the direction. Now, for example, if you look at 2000 to 2013, the S&P went sideways. The return was, I think the return wasn't positive until right around July of 2013, I believe. So if you take January of 2000 to July of 2013, now I'm creating a chart crime here by carving out those specific dates, but I'm doing it for illustrative purposes. I'm not doing it to say that equities didn't do very well. I'm doing it to point out that when people talk about buy and hold strategies, they say, well, buy and hold indexing is the best strategy. It can be. It's not always. If you're holding for 100 years, yes, it is a better opportunity than bonds, for example, in comparison. But most people are not going to be alive for 100 years. And you're certainly not going to be an investor for 100 years. Somebody who's 105 didn't start investing at 5 years old. So the reality is 100 years is a better data point, but it's also not accurate. That's in itself a chart crime because you're not going to be alive for those 100 years. So if you're saying, well, if you had done this, yes, if you had done that, did you do that? No, you did not. So it's really not relevant of if you did this kind of a scenario. However, here's what I'm trying to point out is that if you're looking at a data set, like if you're looking at somebody who's an indexer, right? Vanguard does great work when it comes to buy and hold indexing. So kudos to them for all the work they've done. And it's very valuable to a lot of people. The lesson I'm pointing out, though, is not that indexing is bad. It's not that buy and hold is bad. It's that the market goes through periods. So the period from 1980 until about 2020, the end of 21, was great for buy and hold. Phenomenal buy and hold period. However, there were periods in time in there where it was not. Now, the period leading up to 1980, so from I think it was 67, 68 until 1980, was a terrible period for buy and hold because the markets went sideways. They actually went up and down a lot, but if you take it start to finish, it was mostly sideways for a 10 to 15 year period. So if you were a buy and hold investor during that period, you didn't do very well. Now, does that mean buy and hold is bad? No. It just means during that period, it didn't do very well. So if you're a buy and hold investor, you can't just say buy and hold is the best because strategies, buy and hold is a strategy. Now, it might be a better strategy than most, but it doesn't operate well in all periods. So the period of the 70s, it didn't work very well because equities were overvalued, because of inflation, because, you can go through the list of the reasons it didn't do very well. But overall, it was not the best strategy for that period. Now, the period from 1980 until 2021, it was a great strategy. And you did very well if you bought and hold for that period for the most part. However, during the period from 2000 to 2013, it didn't do very well because during that period, in the peak of 2000, equities were overvalued. And it took them 13 years to work off that overvaluation until 2013, where it actually started to be profitable again if you had started in January of 2000. Now, I'm mixing chart crimes because I'm trying to prove a point, not to say that I'm right and other people are wrong. I'm proving a point in that your methodology of investing has to line up with the environment. So if you bought in January of 2000 and you buy and hold, you didn't do very well. And you'd be like, well, buy and hold doesn't work. Well, it does work. It just didn't work during that period because of the overvaluation. Now, if you buy now, I don't know the future, but I would suspect because what we've talked about is we're in a new paradigm. And the new paradigm means that the old paradigm methodologies don't necessarily work. Now, what we talk about is the new paradigm is higher interest rates, and with higher interest rates come a change in the paradigm. Now, we had 0% interest rates for so long that people are just been conditioned to markets always go up. Oh, the Fed prints money, markets go up. We've been conditioned. With higher interest rates, it changes the paradigm. I don't know what the new paradigm is going to look like, but I suspect I do based on history. And which is what I'm talking about is history. I'm looking at history and saying, well, higher interest rates lead to this. They lead to more defaults, more bankruptcies, more foreclosures, all the things that happen because people have a lot of debt because it was 0% interest rates. So why not borrow? But now you got to pay that back because interest rates are so high. So all these paradigms are leading up to my thesis of where things are going to go. Could I be wrong? Yes, I could absolutely be wrong. But if you don't notice that it's a new paradigm, you could get yourself into trouble. And that's the point, is that when you're in the old paradigm, buy and hold works. New paradigm, buy and hold isn't necessarily going to work. We saw that last 2 years ago, 2022, when all markets went down, bonds and stocks. Now, here's another indicator of a new paradigm. Bonds and stocks are now correlated. Now, we were all raised, at least when I started, we were all raised with stocks and bonds. You have them both because they're not correlated with each other, which balance out and reduce the risk of the portfolio. Now, that was largely true for that 40-year period. It is no longer true. So, if you've diversified with stocks and bonds for correlation purposes, then you could be setting yourself up for massive failure. We saw that 2 years ago in 2022 when both stocks and bonds went down. 30-year treasuries, I think, lost like close to 50%. That is a safe bond, right? We're all taught that bonds are safe. I'm using air quotes for you, audio viewers. So they're not safe. They have been safe for 40 years because yields have gone down, which means they've made money. But when yields go up, bonds are no longer safe. You actually can lose a tremendous amount of money, which we talked about prior to that. You can lose up to 50% or more, which it did for the 30 years. Now, so I just wanted to point this out because we're mixing periods, but I'm using that for illustrative purposes. You need to understand that there are different tools for different periods. If you're using the wrong tool for the wrong period, you can get yourself into trouble. And that's the lesson, is you need to have the right tool for the right set of circumstances. Does buy and hold work? Absolutely, but not all the time. Do bonds and stocks help lower risk by offsetting each other? Yes, they do, but not all the time. And I'm actually going to share a picture because this was such a brilliant picture. I love it. And I have to thank Doug for sending this to me. And it's the difference between correlation and causation. So for all you audio viewers, please go to YouTube or go to our website so you can see the video. It's basically showing a roof that has turned into a V, so that it looks like some like big rock has hit it. And there's a cat sitting at the bottom of that V, and it makes it look like the cat is causing the roof to collapse. And it was a tweet, and it was the tweet is correlation is not causation. This is so brilliant on so many levels. But this is the point, right? Is just because you see a cat sitting at the lowest point of the roof, making it look like the cat caused it. The cat obviously didn't cause the roof to collapse, but it looks like it did. So when you're looking at stocks and bonds, correlation is not causation. Just because you see something happening doesn't mean that it caused it. And we all get caught into this. It's human nature, right? We are pattern recognition machines. So we're constantly looking at things saying, hey, this is related. So it's obviously causative. It's actually very rarely causative. We talked about that last week. But we do get caught into that mindset, that trap that correlation equals causation. And it doesn't. They're two completely separate things. Most things are correlation, and it's really hard to prove causation. And people have been arguing with me, or listeners, with, well, bonds and stocks, it's causative. Like stocks went down, so bonds went up. You can't prove that. They're correlated. They're highly correlated, but it doesn't mean you can prove it, because there are periods like now where it's the opposite. They're very highly correlated, not inversely correlated. Sorry, I meant inversely correlated before. Now they're correlated. So you need to understand that there is a difference, and you can't always prove in the market. You can rarely prove when something's true or not. You can prove they're correlated, but you can't prove causation many times because the market isn't built that way. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money. So I've been doing a lot of talking, Phil. You want to chime in here? And what are some
Sure,
of your...
happy to. So a couple things that I thought of as I was listening to what you had to say. First, it's like I remember when I worked as an analyst and I'd get a call. Why did the market do whatever it did in a certain day? We don't know. We're guessing. And maybe we can figure it out afterwards, but not while it's happening because there's too many things going on. It's not so easy to always figure out what the cause is. But the other things that I'm thinking about in a financial advisory type context is sequence of returns is something else that comes into play here, right? When we retire, we're no longer adding money to the market. And if the market falls a lot the year that we retire, that's really difficult for us. If it goes, think about if the market returned 10% a year, but it did that by going up 20% a year for 10 years and then zero for the next 10 or even negative for the next 10, right? That's much different than if it went negative for the first 10 years and then it went up every year after that because of the fact that you have a different pool of money that you're working with. So when those returns happens matters a lot too. So you have to think about sequence of returns. And the other thing that people often leave out when they're thinking about all this is something that I saw with my grandparents, which is reinvestment risk. My grandmother and grandfather retired when interest rates were really high back in the 80s. And they did it because my grandfather had invested in all these bonds and he didn't know that they could be called, which means that the issuer has the right to pay you and take the bond back. And they do that when interest rates start to fall. Well, he didn't realize that was going to happen. And because of it, he said, well, we can retire because we're getting 20+% from all these bonds. And then the bonds got called and they couldn't reinvest at the same rate. So there's just a lot of things that we have to think about when we're investing. It's not just what's happening now. It's what's happening. It's the future. You have to think about what's going to happen in the future. And you're right. I am a buy and hold guy, but I know buy and hold doesn't always work. So that's why one of the things I like to do too is make sure that the investments that I have pay me a yield. So at least during those times when I'm just holding on, I'm still getting something. I'm getting that yield. I'm getting that dividend or I'm getting that interest, whatever it may be from my investments. I call it being paid to wait. And I think that's really important too. You have to take all those things into consideration. Not every strategy works all the time. That's momentum. There's a lot of momentum that comes to the market. That's sentiment. I don't look at charts very much. I remember when I was an analyst getting called and say, hey, could you talk to me about this chart? I'm like, yeah, I studied that in my CFA program, but I'm not a chartist. I don't do that. I look to see what things have done, but I'm more of a fundamental type of guy. And fundamentals don't always rule the day either. So you always have to know that whatever it is that you think is right, it's not right in every environment.
Yeah, that's a great point, Phil. And I want to bring up a few more charts and get your thoughts here because I know let me see if I can pull them up here. So there's a rotational theory. Now you bring up kind of your history. I don't know if this kind of bakes into your thinking, but there are many different styles of investing, right? There are chartists, as Phil says. There's fundamentalists. There's people who are more rotation based. They focus on sector rotation. Now I'm curious, Phil, do people really still invest in value stocks and get dividends? Is that really a thing? Because I thought you just invested in like the Magnificent Seven and you went all in, right? I thought isn't that the investment strategy people use nowadays? Unfortunately, it's more truth than not. But It'd be nice to see, like, and there's stocks. I mean, there's one company, I think it pays close to 10% dividends, and it's like it's a state, it's a large cap staple. Like, I'm not sure if it's going to continue to pay. It's usually when you see that, it's kind of like, well, are they going to continue to pay? But there's a few companies out there that pay really high dividends, and people just don't bother because they're like, it's not going to appreciate the way that big tech will. Like, what if big tech doesn't like actually? And I point this out because people have been buying the Magnificent Seven so long they haven't realized that they actually haven't done well this year. One of the biggest companies in the world is actually negative returns this year, even though the index is up like 10%. So, you know, what's going on there? What am I missing? Right. And some of them obviously are doing well, but some of them aren't. But it has to give you pause. So I bring this up and I point this sector rotation chart out. Do you want to discuss this, Phil, but it just basically for those listeners, I'll explain it. It shows all the different sectors and it shows different parts of the economic cycle, which I don't even know if we have an economic cycle anymore because they don't let us hit recessions. But hypothetically, if we did, this is what it would look like.
I
Do you
mean,
ever look at this at all, Phil?
I'm aware of it. I know that when the economy is going well, that's when things like consumer discretionary do well because the economy is doing well. People are perceived to have more money to spend. So things that are considered luxury items, the more bigger ticket items, those do well. When you're in the early stages, that's when we're doing things like building infrastructure and things like that. New activities going on because we're preparing for that next upcycle. So that's when you're going to see things like industrials and energy can do well. When the economy contracts, those things don't do well. So there is a line of thought that says that there's certain things that do well in certain environments, and consumer staples do better than consumer discretionary when we have a weaker economy. As I said, when the economy gets stronger, that reverses. So there's a lot of that happens, but it has gotten harder to identify those cycles now because we're constantly, it seems to be trying to do things to avoid recession, and that's not necessarily bad that we're doing that, but yet the economy does have to go through its cycles because we do have excess, and sometimes what the recession does is get rid of some of that excess. So, but the basic idea here is that there's certain sectors of the economy that do better in certain when the economy is doing well, when the economy is doing poorly, and when it's just humming along. That's the basic thing. Yeah, you mentioned like the stocks paying those really high dividends. I mean, one thing that you have to be careful of when that happens is a lot of times the reason that those stocks have such high dividends is because the market really expects them to be cut. Right, like a high quality stock that has a 10% yield. I don't know which stock you're thinking of, but that stock is often a candidate. The market thinks that stock is going to cut the dividend because if you look at its historical yield, let's say that it was 4 to 5%, now it's 10. Well, the market expects that it's going to be cut.
Yeah, and this I won't say which company it is, but it's a smoking company. So we'll just leave it at that. So there's also another one that's run by a famous investor that pays I think a double-digit dividend at the moment, but also I think your point is valid. Of this is potentially the dividend getting cut. I think is the thing. So I want to point out a few things here. So the first one is a tweet by Liz Ann Saunders, who is a very knowledgeable person. So she's the chief investment strategist, I believe, of Schwab. I may have mixed her title, but anyway, she's the chief investor at Schwab is basically what it comes down to, and she's wicked smart, as we say here in Boston. But anyway, so I like this chart because it points out that where the buying of the stocks are coming from, and it looks like net demand for U.S. equities looks like mutual funds is down, pensions are down, households are up a little bit, foreign investors are up, and corporations are up huge, basically pointing to stock buybacks. So a lot of the growth has come from stock buybacks, and this is since 2000. And I will point out that since 2000, we've had very low interest rates. So if you can borrow at 3% for 30 years, and you can use that money to buy back your stock, and your stock is growing at 20% a year, that's what we call financial engineering. And there's nothing wrong with it, but why wouldn't you do that? I mean, if I was there's actually some famous investors that have talked about this, that they wanted to buy a company and bring it public just to do this. I think they did this. Eddie Lampert, I think is the guy's name, over at who bought Sears. He was the
Yep.
hedge fund guy who bought into Sears, and it was this conglomeration of companies in there, and there was an insurance company, there was a leasing company, there were the stores, there were like a bunch of different things, and what he did over time is he basically broke apart and spun out all these different entities. But you look at a guy like that who's really smart when it comes to financials, and then you got another guy who, what was the company? Was it Carmart, or I forget that there was another company where basically the guy bought the company and he just buys back shares. Like his theme was, let's just buy back shares with the cash flow. And um, there's a few companies out there. I don't want to start naming companies because there's another company that is a trust. It's this weird structure where the trust is basically land that used to be owned by the railroads, and so when the state put the land into a trust, and the trust job is basically to manage the land, and so they lease out the land. There's oil, there's natural gas rights, oil rights that they get paid on. They lease it out to farmers. There's all sorts of stuff. Anyway, they use the cash flow to buy back shares. It is in the trust. It is legitimately put in there that says we have to use this to buy back shares. So the net result is in like 100 years, whatever it is, there'd be one share left because all the cash flow goes to buy shares. So eventually the share price is going to be astronomical. So it's a math problem, right? It's compounding. It's a great illustration of what can be done. But the point is if you can borrow at 0% and you can use that money to buy shares, and those shares can grow at 20% a year, why wouldn't you do that? It's just math. So a lot of companies are doing that. And people, you got politicians saying they shouldn't be doing this. It should be illegal. Well, what should be illegal is you pegging interest rates at 0%, which is causing this. And this is actually one of the objections I have to politics in large part, is because they fight the symptoms and not the cause, right? They're saying, well, it's unfair. We have, we have wealth disparity and wealth inequality. It's like, well, yes, all of that is caused because of inflation and low interest rates. If you fix that, wealth inequality fixes itself. And so, and unfortunately, politicians aren't very smart, or at least in this area. And so they don't understand that it's all built, and maybe they do understand, they don't care. I mean, they're anyway. But the point is as investors, you need to understand this dynamic: is that when you have inflation, it causes wealth inequality. And so if you want to fix that, then you need to fix the inflation issue or the money printing issue, right? And so the reason that a lot of this happened is because I think it was 2010 or 12, somewhere in that neighborhood. All the corporations, it's like they all got together in a meeting and they decided, hey, look at all this free money that we can pick up. And they decided, let's borrow at zero and let's just buy back shares. And they've been doing it consistently. And if you look back, and I don't have this chart in front of me, but I have seen it before, where if you look back like 40 years, this didn't always happen. But it did start to happen after we had low interest rates, magically, right? It didn't happen before that, but after that, people were like, you're basically giving us free money and we can go buy back shares and our company earnings are growing 20% a year. Why wouldn't we do this? It's a no-brainer. So this is actually part of a strategy that Meb Faber has, which I really like, called the shareholder yield strategy. I don't think he created it. He actually dubbed it from someone else. I forget the guy's name, but it was he improved it. The strategy was basically look for companies buying back shares. You look for companies that are paying out a dividend and increasing it over time. And the additive part, and that was the strategy: companies that buy back shares and pay out a dividend that keeps increasing. Because what that shows is cash flows increasing over time. Now, his improvement was he found out is that if you look for companies that are actually paying down debt, that even more improves it, right? Because you're over time, you're improving cash flow ever so gradually. So if you look at those factors, that's his thesis of quant strategy of finding good investments. Anyway, I just kind of point this out because it's a really interesting marker and people talk about it a lot, but I wanted people to really see where the net demand for equities is coming from. Um, Also, let's see, wanted to point out this one other chart that I frequently refer to in the show, but don't always have at my fingertips. Here's a chart that we talk about in the show when we talk about mental models. And Wall Street likes to pipe out part of this chart. And what they'll show you is for those listeners, once again, just look at the charts on the website or on YouTube or any of the other socials that we're live on. You'll see this chart, but the chart basically shows back to '93. And I know picking that date could be a chart crime, but it's more illustrative purposes, so forgive that. Um, anyway, the point is if you look at this chart, the blue in the middle is the S&P if you bought and hold over that period, right? There's nothing sexy or different about it. It's just the S&P 500 picking a random period. Now, if you look at if you missed the 10 best days, your performance would have lagged uh, by a lot. Let's just say it that way. It's the numbers here. The S&P goes from, it looks like 1 up till 1,000 over that period of time. And if you miss the 10 best days, it would have been somewhere around 480 or something like that. Okay. So big difference, right? Half the performance over that period of time, which is quite significant, right? However, what this chart shows and what Wall Street will never show you is if you miss the 10 worst days each year, what would your performance have been? So if the S&P is at 1,000, missing the 10 worst days, the S&P would have been close to 2,500. So, two and a half X of what it would have been otherwise. So the point is that when you get shown a narrative of missing the 10 worst days is very terrible. Yes, it obviously is terrible. But if you miss the 10 worst days, you would have done so much better. Now, am I telling you that you should time the markets? No, I'm not. That's not the point of what I'm saying. The point of what I'm saying is that chart crimes, and this is uncovering a Wall Street chart crime that they use all the time to show you a narrative, which is buy and hold, never sell. Buy our stuff and don't sell it. That's the wrong point, right? The right point is that you should know that this is a narrative and see that buying and holding is not always the best approach. Even though we're showing you a period where buy and hold is the best approach, right? In general, buy and hold is a better strategy. Now, what you'll notice here is that there starts to be a deviation around 2000, which obviously is a period that we talked about, 2000, 2013. There was a big disparity, but also in future years, this disparity continues, especially in 2020. So if you look at, and I'll point out the big disparity in 2020 comes with, missing those big down days, which happened, some of the most violent down days we've had. But it goes to show that if you look at this disparity, what you'll see is that you shouldn't just buy and hold, right? And what I'll also point out on the other side of it is that if you miss the 10 worst days, you know when those are? Those are right before the 10 best days. So this is the point I want to give people, is that if you're looking at data, and this in itself is a chart crime, because if you're looking at the data and you're saying, well, this obviously means that I should miss the 10 worst days. Yes, that's what it means. But can you do that? No, it's impossible to judge when those are. You can't predict the future. So you can't pick either one. Okay. However, I will point out that the 10 best days and 10 worst days are typically next to each other. The reason being is the 10 worst days are usually when something falls off the cliff. When I think it was 2011, when we had that flash crash, that was a really bad day. And it didn't end up being as bad because the market recovered, but it was really bad. And if you missed that, you were in good shape. But if you look at the other side of it, right, it went down, I think, like 20 some odd percent in a matter of like minutes, but then it recovered, right? So it went up 20 some odd percent in a matter of minutes. So what typically happens when you have a crash of sorts is there's a rebound on the other side, which tends to be the best days, right? So you're kind of on. If you remove both, then you end up being very similar to where you were. So it ends up kind of neutralizing itself out. So you can kind of ignore both of these and focus on the performance of the S&P. If you're lucky enough to miss some bad days, good on you. But it's luck. You can't time that. There's no way you can know, if there's like we had a week ago, and I want Phil to talk about this a little bit because we had some news in the last week of, what happened over in the Middle East. But, if you remove stuff like that, you don't know when people are going to attack each other. You have no idea unless you're a politician and they can trade in insider information, but the rest of us don't know. So anyway, I just wanted to point that out because I saw this week and I love this chart and just wanted to share it because I frequently talk about it without sharing it. So anyway, Phil, what are some news updates that we can talk about that for the audio viewers?
So one thing is, last week we had a difficult market, and just the idea here too that you're talking about with the best and the worst days is that a lot of times those best days actually happen during bad markets, not the good ones, because the good markets are typically ones that slow and steady. We don't have a lot of boom days. The market's more volatile when it's going down than when it's going up. So a lot of times those days come there, and you also have to be careful. I mean, I know we talk about not timing, but remember that if you're trying to do that, especially if it's a taxable portfolio, there's so many frictional costs that you start to add in because now all of a sudden you got to worry about taxes. And if those are short-term trades, you're paying taxes at a much higher rate than if it's things that's shown for a long term. So that's just other things that make it very difficult to try to execute that type of strategy. And it's rare, if ever, that you find somebody that can really do that with any kind of sustained record of success. Anyway, last week the market had a tough week. A lot of it seemed to revolve around what's going on in the Middle East. There was an outbreak of some violence there. I don't know what's going to happen. The market didn't like it. There's a lot of uncertainty that causes, and that uncertainty the market doesn't like. I mean, I guess the one thing that I read, there was an article in Barron's over the weekend that talked about the idea that in some ways the fact that the market went down like that was healthy, because if we had a bubble, when we have a bubble, bad news never sends the market down, because it's everybody has a pie in the sky, things are going up, and they just kind of brush off and ignore everything. Well, the market fell last week, so that potentially is a positive development because of the fact that the market went down and it didn't just keep going up when there was some bad news. And then the market rebounded yesterday. Exactly why, I don't know for sure. None of us know for sure, but the market had a better day yesterday. It's opened up stronger today, but we don't really know what's going to happen. And I was also talking to Kirk at the beginning, something else that I saw that I thought was really interesting in some research that I read that was saying that, and we always think about the idea that a rising interest rate environment is bad. The news that I was reading said that if you look at the increase in interest income that we're getting, it's offsetting the higher expense. So maybe it's not as bad net as we think because there's offsets there. And so sometimes we just look at one side, just like in the chart that Kirk shared, right? If you look at the market without the bad days, it goes way up. If you look at it without the good days, it goes down. The one that kind of falls in the middle, but it's to the lower end just because of how bad those days are, was the one where you just stayed steady throughout. I just want to point out one other thing when you were talking about the buybacks. As people, we do that. Right? Interest rates are low. If you have an old mortgage and you've got a rate that's somewhere in the vicinity of 3%, I know a lot of us want to pay down our debt, but when it's 3%, there's no reason to pay it off too fast. You can take that money and just put it into a 1-year treasury and get 5%. You got a 3% mortgage rate. You come out ahead. It's the exact same thing that we're talking about with companies we're doing when they're buying back stock because rates are so low and they have all this free or borrowing money because it's so cheap. You have cheap debt. Take advantage of it. I had a client I was speaking to last week or the week before, and she said, we got some extra money. We've been paying down our debt. Is that the best thing to do? And I said, well, let's look at your mortgage rate. And it was 2 5/8. I said, I don't think that we should really be repaying the debt. You can put it in the bank. Actually, even better, she wasn't maxing out her 401k at work. I said, increase your 401k. We can get a tax break. and we have the ability to have that money grow as opposed to putting it in there to avoid a cost of only 2 5/8. So you have to look at the big picture. You can't just look at little pieces.
Yeah, this is actually something interesting. It came up recently. I don't know, for the listeners who've been around for a while, you might remember this, but mortgages used to be assignable. You used to be able to take your mortgage with you. So if you had a house, you could assign it. You could assign the mortgage to somebody else. So if you bought the house and you had a 2% mortgage, you could sell the house to somebody and keep. They could take over the mortgage for you, which in today's they don't do that anymore for very good reason. But today that would be extremely valuable. I mean, if I could sell my house with a 2.5% mortgage, I could overcharge people for that because it's so low. And and I look at this, and anybody who has to move now, I feel sorry for them because you're going from like a 3% mortgage or somewhere thereabouts up to 8 plus. That's not insignificant. That's basically doubling your monthly payment. So I had flashed this chart here because somebody sent it to me. It's the U.S. It's a chart about the debt clock. The debt to GDP ratio is 122%. The interest on debt, the net interest on debt, is basically $800 billion a year. And this shows the largest budget items. Uh, 1.7 trillion Medicare, Medicaid, Social Security is 1.4 trillion. Defense and war is 881 billion, and net interest on debt is 800 billion. So if you look at this, and this is to Phil's point, and I'm curious on the math on what you were talking about on the offsets, but I mean, 800 billion a year interest on debt. You're basically lighting $1 trillion, almost $1 trillion on fire every year. And as that debt rolls over, the interest is going to increase because we have higher interest rates now. We have 5.5% compared to before, which was close to zero. So there was a chart. I wish I could have found this. I think it was John Hussman who put it out, which basically showed it was like an asymptotic chart. For those of you who don't know what that means, there's an X and a Y axis, and then there's a line. For those of you who know calculus, there's a line that hugs but never touches the X and the Y, but it curves around it. And so what it showed was on one axis, and I forget the chart. It was like I think on the X axis it was interest rate, and the Y axis is the amount of debt. So the point is when you have 0% interest rates, you can take out an infinite amount of debt, right? There's no limit if you're paying zero. Because you borrow $1 billion, you're paying back $1 billion. Like, it doesn't cost you anything. So you can take out as much as they'll give you. However, if interest rates are 100%, you can take out very little, if any, right? Because it doesn't make sense to borrow money at 100%, right? Unless you got to pay your bookie. By the way, I just saw. I was on the plane. I saw this Molly's Game on Netflix. It was actually a pretty interesting movie. I guess it was somewhat based on a real story, but it was a fascinating movie. Anyway, but if you look at it, so the point is the lower the interest rate, the more debt you can take out. Now that's okay if interest rates are pegged to zero, but once they go up to 5, now you're away from the line. Now you can't afford that. Now that doesn't happen right away. It'll happen over 5-10 years where this debt will come due and you have to roll it over at 5%. So that interest rate's going to keep going up as long as rates are up. Now my prediction is we're going to have higher rates for longer. I think we are. I think it's inevitable that we're going to keep having rates where they are because the economy is doing fine. The stock market's doing fine. Inflation is picking up a little bit, but it's still fine. Why do you need to raise interest rates? Why do you need to lower them? This is what we predicted 2 years ago, that 5 to 5.5% would be the range. And that's where we are. And I don't think I think interest rates are going to stay higher for longer than most people predict. I've also said this for a few years. They're going to be higher than longer than most people predict. And so what's happened so far this year? People went into the year thinking it was going to be 7 rate drops. We said 0, maybe 1. Where are we? People are wising up to the fact that we could be, people think, well, we're going to have 1 in June or September. I'd be surprised if we have 1. Now, that could change. We could have a massive recession. All bets are off. We go into recession. But I'm not seeing that. And that's the problem. Most people are predicting a recession, but we're not seeing it at the moment. Now, it could happen. I think in the second half of this year, there's a likelihood we'll start to see an impact of that, but we're not seeing it yet. And that's surprising even me. I predicted it would have happened sooner, so I've been wrong on that. But I've been right on the inflation part that we're interest rates are going to be where they are. So it's really this, and I'll point this out because I think 2 weeks ago I had a segment of I'm wrong, right? And it's important to know when you're wrong, and it's important to talk about it, because if you come out and just say you're right all the time, nobody believes you, because they just think, oh, you're right all the time. You're a buffoon. Nobody's right all the time. I'm wrong a lot, right? And I talk about it here because I think it's instructive for people to acknowledge when they're wrong, because if you don't, that's when you make foolish errors. Oh, the stock market, it's going to keep going up. Oh, it's down 5%. No, it's going to bounce back 10%. No, I'm going to buy more, right? It's lower. I'm going to buy more. And it keeps going down. At some point, you're like, oh, it's down 95%. I guess I was wrong. Well, it's too late, right? So you need to acknowledge your failures. Everyone does in all parts of our lives, because that's how you learn. That's how you improve what you're doing. So, if you look at where we are right now, I've been certainly wrong in the timing of the recession. The economy's been much more resilient than I think. However, high interest rates are eventually going to slow down the economy. They have to. It's the whole point. That's why they raise rates, to slow down the economy, and it works. It just hasn't worked this time. So the real question is were they too low to begin with? Yeah, probably. Are stocks too expensive? Yes, they are. And if you look at this chart, and then we're going to kind of wrap it up here. If you look at this chart by GMO, and I use their chart here, the most recent one, this is their valuation metrics. By their metrics, the U.S. large cap stocks are negative 4.9% a year real return, which means that, let's say it's 5%. You're looking at a negative 35% return over the next 7 years. That's what that says. That's I'm trying to describe the chart. Now, if you look at international emerging markets, they'll do rather well, right? If you look at bonds, they'll do okay. So obviously, this is more for a marker, not what it's actually going to do. Because if you looked at 2 months ago, the real returns for U.S. large were different. But the point is you have to acknowledge the fact that there's a lot of moving pieces here, and you could be wrong. But higher interest rates is not a good thing for the economy, and eventually it's going to impact things, and that could cause rates to drop. But at the moment, the Fed's in a corner, and they can't change it. And if they do change it, you have to wonder why. Like, what are they seeing that we're not seeing? If they start dropping rates, I do admit they might drop it once, but we have an election year coming up, and if they drop it going to election, that's actually politically an agreed upon thing that you never do as the Fed. Like, you don't interfere with elections. So after August, I'd be shocked if they do anything with rates, because that will be considered interfering with elections. So if we go into recession, all bets are off. But if you look at if it's like it is now, I don't think they're going to lower rates going past August, because that's election interference by both parties, and they would be very pissed at Powell for doing that. So I think if they're going to do it, they have to do it before August, and I don't think they're going to do it before August, because there's no reason to at the moment. So anyway, Phil, final thoughts, and take us home here.
The bottom line here on all these things is, when you're looking at investing, there's always two sides to the story. You want to make sure you understand both sides. Don't just take one narrative over another. Pictures tell us a lot, but remember where that picture's coming from and what it's taken into account, because it's probably leaving something out, because it's probably got some type of bias in there. Whatever story they want to tell, they're going to pick the data that fits their story. So, as always, do your own research, make your own decisions, and make sure you understand why. As for me, I work with women who are experiencing big life transitions, which I know can be stressful. So my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for our blog. Thanks for having me today, Kirk. Enjoyed it.
Yeah, thanks for coming on, Phil. And I just wanted to thank Charlie for his comment. Please, listeners, send in your comments, questions, feedback. If you hate the show, let us know. If you love the show, let us know. Like we just love feedback because that's how we make the show better. So I want to thank Charlie for his question and comments. Also, he made another comment which I want to point out because I did mention this in the last few weeks, and I think I've said it enough where I want to mention it. But Charlie's comment was that I can't mention any companies because I want to be sued. I want to. And he talked about a free speech. I will just point out that I'm a licensed financial advisor. I don't have free speech. There's two parts to this. One is as a regulated advisor, and Phil's the same. There's certain things we can't say, and there's certain things we shouldn't say, right? And I have to navigate that all the time. Is that there's certain things that I don't want to say because I can't give investment advice on the show. Like you'll if you've been a listener to the show for a while, you clearly notice that I'm not giving you advice. Buy this stock, sell this stock. I can't. I probably could with a ton of disclaimers, but I don't feel that doing that is instructive. The reason we do the show the way we do it is because we're trying to teach you frameworks. We're trying to teach you mental models and how to think, not what to think. So if I got in the show and I started giving you investment advice, I'd be telling you what to think. And the whole point of the show is to teach you the opposite of that, how to think. Because once you know how to think, you know what to think. Because your situation is different from mine, right? Or anyone else's. And so if I gave you advice on a stock, maybe it works for you, maybe it doesn't for different reasons. So it doesn't make sense for me to give broad-based advice to everybody. Can I give you individual advice? Yes. Give me a call, shoot me an email, and I'll give you individual advice. But as a platform, I don't think it's the right thing to do. And also, there's some restrictions on there. Also, I mentioned a few times, not saying companies, or not really companies, but people by name, not getting sued. And you talk about a free speech amendment. Let me tell you, we do have free speech still in this country, I think, although it's questionable sometimes. We do have free speech in this country, but getting sued, even though you have free speech to say something, so I could disparage somebody in the show, but technically they could also sue me. So I don't have deep pockets enough to fight a lawsuit against Donald Trump, who likes to sue everybody, as everybody knows. So I'm not going to say anything about the guy, right? Like, because I don't want to get sued, because I know he'll sue me. Some other people do that. So it's just more of, I mentioned that because when I say I don't want to get sued, like I mentioned certain concepts because I think they're important for people to understand, but I don't want to mention the people because I don't like disparaging people for one. I don't think it's right. But I think the way that they structure things are instructive. So I mention it without mentioning the person because I don't, because it's close enough where I wouldn't want somebody saying that about me, so I'm not going to mention their name. But those of you who listen to 50 million podcasts, you probably know who I'm talking about sometimes. Anyway, but that's just kind of where I come from. So I just want to put that footnote in there because I do get comments sometimes about why don't you do this? Why do you do this? So I just wanted to explain why we do these things, so you know where I'm coming from. It's complete transparency and authenticity. And if you guys think that I'm full of it, shoot me an email. Send me a message. If you think I'm not being transparent, let me know and I'll talk about it in the show. Because I think, there are certain borders and barriers that we have as licensed professionals. And there's just certain things based on ethics and kind of doing the right thing by people that I kind of follow in addition to that. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.